Hi friends, welcome to my channel Investors Arsenal. My goal here is to share practical investing knowledge and equip new investors with tools, frameworks, and insights they can apply in their own investing journey. In today's video, I'll walk you through a basic framework for conducting fundamental analysis of a stock. The goal of this video is to give you a high level overview of a basic framework for conducting fundamental analysis which can be applicable to Indian, US, UK, or any other stock. Did you recently hear about any stock tip from a friend or through social media platforms or news channel? I'm sure you must have. But wait, before putting money into a company, stop and ask yourself, do I really understand this business? This is your hard earned money, remember. So caution matters. When you're trying to buy a new phone, refrigerator, car, or an air conditioner, do you buy it without doing any kind of research? I'm sure the answer is no for almost everyone. Try to apply the same kind of diligence before buying a stock. It's important to understand the underlying fundamentals of the business before making any decision. Imagine a stranger asking you to invest in their company. Would you do it without any questions or without doing any kind of research? For most of us, the answer is no. Step one is to understand the company, its business, and the industry in which it operates. Start by understanding the company's key products or services. Visit its website. Learn who its customers are, whether it's business to business, that is B2B or B2C. Try to understand its business model, whether it operates through stores, franchisees, or other channels. Understand its geographical reach. Check online reviews and, if possible, even visit a store to see the business in action. Evaluate the company's competitive advantages. Is it a monopoly or a key player in a competitive market? Understanding its position helps shape your investment strategy. Remember, strong competition can lead to lower prices, higher marketing cost, and reduced profits. Look at the current industry trends. For example, AI, electric vehicles, and solar energy are growing, right? While news printing is declining. Understanding trends can help you gauge future performance and viability. Though not every company in a rising industry will succeed, it's a useful starting point for sure. Try to gather as much information about the management as possible. Take Tesla for example. Strong leadership often matters more than most people realize. Does the management have the right education or relevant experience? This gives insight into their ability to lead the company effectively. Most importantly, check for any negative news or legal cases against the promoters. These should be immediate red flags. Once you're comfortable with the insights from step 1, move on to step 2, which is analyzing the company's financial performance. Start with the income statement. Check the company's revenue, sales growth, and profit margins. Analyzing the income statement is key to understanding a company's financial health. It shows quarterly or annual performance, helping you track revenue trends over time. Look for consistent growth, whether the company is steadily expanding, whether it is seasonal or cyclical. Then compare its growth rate with the industry peers. Strong growth usually signals high demand and effective sales strategies. Margins reveal a company's profitability relative to revenue. Focus on gross margins, operating margins, and net margins. High margins often indicate strong cost management and pricing, while declining margins may signal inefficiencies or rising competition. A balance sheet shows a company's financial position on a specific date. Think of it like this: your income statement is your salary, your assets are savings, investments, or property, and your liabilities are loans or credit card debt. The same applies to a company. For strong financial health, assets should exceed liabilities. The balance sheet shows the net worth of the company. Analyzing cash levels helps investors gauge financial flexibility. As an analogy, if a person is living, say, paycheck to paycheck, you can imagine the challenges it may have to face if there's a delay in a month's salary, or there are any unanticipated expenses. It's important, and hence it's important to have cash reserves. Debt levels show a company's financial leverage and risk. Investors should examine both short-term and long-term liabilities to assess potential repayment challenges. If a heavily indebted company underperforms, it may have to cut operations or sell assets, which can hurt both the company and the shareholders. Fixed assets like property, equipment, and technology often make up a large part of a company's total assets. Service based businesses like IT typically have fewer assets, while capital intensive manufacturing companies like steel manufacturers hold significant amounts of fixed assets. Receivables show how much customers owe the company. High receivables relative to revenue may signal cash flow issues, while low receivables indicate efficient collections. If the company requires its customers to prepay it, then it's advantageous to the business. Look at what percentage of assets is tied up in inventory and whether inventory levels have grown over time. Determine if changes are due to the broader market or is it specific to the company. It's important to also analyze the free cash flow which the business is able to produce. Free cash flow is calculated as cash generated from operations minus capital expenditures. It indicates how much cash is available for distribution to shareholders, for reinvestment, or debt reduction. As a general rule, the higher the better. A positive free cash flow indicates financial stability, while negative could signal potential issues, especially if it persists over multiple periods. Temporary negative free cash flow is normal during expansions or major investments, but it shouldn't continue over the long term. Something to keep in mind. Step 3 is to take a closer look at key financial ratios. We'll just discuss about a few essential ones. Key ratios such as return on capital employed, return on equity, debt equity ratio reveal a company's profitability and how efficiently it uses capital. Let's talk about ROCE and ROE. ROCE tells us how efficiently a company is using its capital to generate profits. Think of it as a profit per dollar invested metric. A higher ROCE means the business is using its resources effectively. Investors usually look for ROCE above the industry average. Around 15% is a good rule of thumb, and tracking it over time shows whether the company is consistently performing well. Similar is the case with ROE, which measures how efficiently a company generates profits from shareholders' equity. Essentially, how much profit the company earns for every dollar invested by its owners. Again, rule of thumb, it should be higher than 15%. The debt equity ratio shows a company's financial leverage by comparing total liabilities to shareholders' equity. A higher debt equity ratio means more leverage and risk, while a lower debt equity ratio indicates a safer financial position. As a general guideline, avoid companies with a debt equity ratio above 2, though acceptable levels can vary by industry. Step 4 is identifying key business risk to understand the risk reward balance so that you can take an informed decision. Understanding key business risks is crucial when evaluating a company's investment potential. Look at concentration risk, whether the company has reliance on just a few customers. Competition risk, barriers to entry, whether there are high or low barriers to entry. Disruption risk, like new technologies. Step 5 is valuation ratios assessment. Key valuation ratios to understand include price earning ratio, price to free cash flow, price to sales, price to book value, which is useful for banks. EV by EBITDA works well for capital intensive companies, right? Together, these ratios give a clear picture of a company's worth and help guide smarter investment decisions. I'll discuss only the key ones. Let's look at PE ratio and price to free cash flow. The PE ratio shows how much investors are willing to pay for each dollar of a company's earnings. A high PE can mean expected growth, but it could also signal overvaluation. For example, a PE of 30 means you are paying $30 for 1 unit of the company's earnings. What is the key to higher returns? Buy good businesses at lower PE, which boosts potential gains and adds a margin of safety. The price to free cash flow ratio is calculated by dividing the company's market capitalization by its free cash flow. Generally, the lower the better, but it should be for quality businesses. Next is reviewing the shareholding pattern and the changes. Reviewing shareholding changes offers insight into market sentiment and investment confidence. Knowing who holds the shares and tracking significant changes can indicate potential future performance. Generally, high promoter and FII holdings or increase in these holdings signal strong confidence in the business and can boost overall investment trust. To complete your research, it is important to review a few additional resources before deciding to buy a stock. Think of this as a dessert. The earliest steps were the starters and the main course. These extra materials can influence your decision, so analyze them after completing the core research. These would include investor presentations and the conference calls. Investor presentations provide an overview of a company's strategy, performance, and future outlook. They usually highlight financials, business updates, and guidance for upcoming quarters. Conference call insights offer real time updates and answers from managements to analysts and investors. Next is brokerage report. Brokerage reports offer key insights into a company's performance, market trends, and investment potential. Other public domain insights can add extra color and perspective, helping you better understand the company, its business, and overall market positioning. Explore educational platforms, YouTube videos, so on and so forth. Check out interviews with industry experts, management discussions, and TV appearances. Watch documentaries and analysis videos on market trends, sectors, or specific companies. At this point, you are well equipped to decide on whether you should buy, hold, or sell the stock in question. Hope you found this video useful. Thank you. Please feel free to drop in comments in the comment section.